Can you see the screen on mine? Here, let me pull this up.
Yeah.
Okay, perfect.
Okay. Let's just give it a second here. Got the link. Share it to everyone.
Sean, see if you look at my screen, do I have to show this or not? See that? This versus this. This versus that.
Sorry, give me a second. I need to have a look here. What are you looking at, dude?
This? Do I need this or not?
I don't see what you're looking at.
Okay, check out my screen. Can you see it or no?
No.
Okay, it's a photo of you and me. It's a photo of you and me.
Oh, I don't see it.
But can you have it on yours?
I don't know what you're talking about. Okay, don't worry about it. Doesn't matter.
Okay.
Okay, I'm just sharing the link here for our group so that everyone can come in. What's going on, everyone? So today, by the way, guys, so we're going to be analyzing earnings events today mainly, and basically walking through what we call our three-step process for actually analyzing options trading events. For those of you that are coming from the options group on Discord, I'm bullish on gains. I've been dropping some information there, trying to help people out with some trades, and I thought we'd start doing some lives here, and I'd start inviting you guys to it so that we can actually show you how I go about finding these trades and analyzing the opportunities that I try to help you guys with. On the line with me is my partner Jordan, so he's actually sharing his screen right now. Little bit of background: Jordan and I have been trading options for a really long time, and we're based in Canada. And in 2019, we won the biggest options trading competition, run by the TSX, so the Toronto Stock Exchange, and the Toronto Montreal Exchange. It's a strictly options trading competition. Came first place, 2,000 contestants. And we manage, we have two businesses. We manage a private fund where we manage private money, and we actually trade options for it. And we manage a private group where we have a small group that we manage that we do some private mentorship and some cool stuff there. But today we're going to be taking you through this tool. And if you have any stocks that you're looking at, any options that you're looking at trading in this coming week, let's say, feel free to leave a comment and let's go over it, right? We'll actually do a free analysis for you. We'll show you how we look at things and how you can look at things to find opportunity, right? So before we get started, I'll just let you know quickly what this process that we follow is. So we have this entire tool here that you can see on Jordan's screen. And the purpose of this tool is to help us find and assess market inefficiencies. So we have 1,400 equities that we look at, 1,400 different stocks loaded into this tool. And we can search for them, and it populates a bunch of information about the options that are traded around that stock. So we can find what we really look for, which is mispricings in the market. So we look for mispricings, we look for inefficiency, and then we try to capitalize on that inefficiency by placing a trade that lets us take a view on it. We're trying to capture a spread between what the price is right now and what we believe the price actually should be. So this tool gives us all the information that we need to find those inefficiencies. And when we find them, we go from there and we actually do some research. So we will actually go, okay, we see the inefficiency. What do we do now? Well, we can't just go and trade it right away. We need to understand why that inefficiency is there. When we can understand why it's there, now we have a good trade. Because if you see something that's mispriced, but you can't understand why, it's still mispriced for a reason. You just don't know why. And that's when you open yourself up to things like insider trading, really sophisticated traders that have better information than you, that might be bidding up the cost of something or selling a bunch of it and driving the price down. Yeah, Cab, so I think MFA is loaded into our tool. We'll take a look at it. If you want us to take a look at it, also drop your idea. So let us know what you're actually thinking of trading around this so that we can help you make a better decision, and we have some guidance as to what you're actually looking at. But to start, we have a couple things we want to look at, because there's one stock in particular that we think is a decent play right now, which is
just
Exxon.
got filled. I just got filled on it.
So you just placed a trade on it.
Just place a trade. Okay, so
amazing.
What's going on, guys? So one thing Sean and I like to do in the mornings is we just like to go on StockTwits and see where the retail are trading. right? Remember, at the end of the day, we want to put ourselves in a good position where on the other side of our trade is going to be someone who is not very sophisticated.
Yeah.
You know, as in poker, they say, you know, the most important thing is finding the right table. So we like to go on StockTwits, see, okay, where is retail right now? And we like to see what's trending. Okay, so what we notice is that Exxon is trending. We can see message volumes at 1475 is at all-time highs for the last 40 days or 30 days, whatever StockTwits gives us here. And so right away we want to say, okay, perfect. There's a lot of retail in this space, and we want to start looking at trade opportunities.
Right. And just quickly, the reason why we look at this is something that people often forget is that a market is a bunch of micro transactions. So a lot of people, like when they think of trading, they're like, it's them against the market, right? But that kind of gets diluted, and they think, you know, it's me versus this big mysterious thing. But what it actually is it's you against another person. If you break down a market to every single trade that happens, there is someone on the buy side and someone on the sell side. And if you can understand who's likely to be on the other side of your trade, that gives you a lot of insight, because depending on who that person is, they have different reasons for being there. You know, if it's a fund on the other side, right, they might have a different reason for being there than a retail trader, like someone who's, you know, betting on something going up. So we look at StockTwits because what we find is that the average trader does not have access to the same level of information and intuition that we do. So when we can make sure that they're on the other side, we have an advantage. The reason we have an advantage is we have access to better information, and we're able to use that information better, which means that we have just a direct information advantage over them. And that's a competitive edge that we can use to our advantage. So when you looked at Exxon there, it was obvious that, you know, there's a lot of retail eyes on it.
A lot of retail eyes. And so, perfect. Now we're in a spot where there's some retail traders. And now we want to say, okay, well, what are they doing? Right? Are they buying options? Are they selling options? Well, this is obviously going to be reflected in the price, in the options price, right? So in the implied volatility number. So we go over to our tool here. We head over to Vol Trader, and we see that, you know, Exxon Vol is pretty bid. It's 63. Our forecast is 54.8, right? So we got like a 5% spread here.
More, we have a 9% spread, or 8.
Oh, sorry, yeah, 9% spread. And if we look at, if we look at the front month, right, it's even more bid, right? It's 65 almost.
So what does that tell you? Just because you know, a lot of, you know, people who are just getting into options may not be familiar with all the terminology.
Gotcha. So as we get closer, so basically what this is saying is that a lot of people are buying up the front end of the curve. They're buying up a lot of the near dated options.
Yeah.
Right? The farther dated options are not as bid.
Mm-hmm.
Okay.
So like, remember what we're always looking at, in the end of the day, when you trade an option, you pay a premium, right? You pay for that option. And what we're saying is that for the short dated options, the premium is more expensive than it should be.
Yeah. Okay. So the retail traders are really pushing up the price of those options. And so what we can do is we can place a trade, right? We can say, okay, well, if volatility is too expensive, let's start selling those options. Let's start selling those options to the retail traders, right? So that's what I just did this morning. Sold some of the this week expiration 43 straddle.
You sell a straddle?
So I have an iron condor on. Bought the wings, sold the straddle, bought the wings. I was thinking of just shorting a straddle because this company doesn't really have like takeover risk. It's probably not going to go bankrupt. So the tail risk is not as big as, like, let's say for a micro cap or a smaller cap.
So just to sum up. So right there, to sum up what we did right now is we looked at this stock, right? So we saw that there was a lot of retail traders looking at it on StockTwits. And when we went into our tool, we instantly looked at the volatility numbers and saw, okay, volatility is higher than what we forecast it to be. The reason that's important to know is because volatility is directly correlated with the price of the options. If you see that the implied volatility is high, the price of the option is going to be high. Mm-hmm. So now and what we said is not only is it high, it's a lot higher than what we think it should be. So there's a gap there between our opinion and the market opinion. The market opinion is being driven by what we forecast to be a lot of retail traders bidding this thing up. and a lot of funds probably looking for some downside protection because this is a pretty big company.
Exactly. And you can actually see, so oil just came out with, they said they're cutting barrels, but we all know that they really aren't going to cut barrels. So it looks like there's still some aftermath left. There's a lot of skew here. It looks like, institutions are still buying up, put protection.
Mhm.
So, that's probably driving the price as well for vol.
Yeah. So just before, the next thing we should do here is like just to walk people through the process, because I think the most important thing that traders need to have is a systematic way to find inefficiency and then understand it. So like if you just went to Google and typed in Exxon, like would there be a news that comes up to reflect why the volatility is high? Like, is this news that something that came out over the weekend? I haven't personally looked into it.
Yeah. So it just came out yesterday. They cut barrels.
Okay, so that is what would drive up the inefficiency or the implied.
Yeah. So what I'm actually thinking is the implied was bid before the weekend, and there's just some residue left. There's some residue, right? There's some residue after the news, and then on top of that, you have the retail coming into the market.
Cool. So this is the interesting thing though, right? When you have news like this come out, right, a lot of people will hop in after the news thinking that it's a good opportunity, buy or sell side, or long or short, whatever they're thinking. But something that you see, a common mistake that traders make is that they don't understand what goes into that pricing, right? So if news comes out that things are going to be bad, the market now expects it to be bad, and it'll be reflected in the price right away. So when they already say things are going to be bad, it's reflected in the price, and now you're trying to get in. The question you need to be asking is not, are things going to be bad? It's, are things going to be worse than what the market thinks it's going to be already?
Yeah.
Right? Or are they going to be better? Because if you just say it's going to be worse and you're in agreement with the market, there's no trade. And that's how people end up getting burned, right? We looked at Gilead a while ago, and when they came out saying that they had, they were in clinical stages trials for a cure for COVID, right? It went bid like crazy. Bid meaning that people were bidding up the price, and demand drove up the price of the options. And they were implying like 8% move every day when no news was even going to come out for 30 days. So it was a no-brainer, and we started selling options there.
Yeah,
It was a great return.
There's still call skew, man. Like people are still bidding this thing up on the upside. I guess they think it's going to find the cure. There's some upside skew. You usually don't see that in equities.
Yeah, it's crazy, right?
Yeah. Okay, so
let's look at
our Exxon trade. Let's move over. Let's head over to earnings. We got earnings season. Doesn't get more fun than earnings season.
Yeah, earnings season is it's definitely thrilling. And there's a lot, like this earnings season, guys. There is so much potential right now. I think this is gonna be a phenomenal earnings season if you can find inefficiency and you know how to assess it, right? So just to start there, Jordan, you want to walk them through what you're doing right there, because this is a really cool feature. This is something that everyone needs access to one way or another. It's a scanner.
Damn, we got so many trades to look at today, man.
Yeah.
Yeah. So remember, guys, we're looking at 1,428 equities here. Okay, so that's a lot. It's a lot for the human mind to go through.
Wait, Jordan.
Yeah.
Before we actually move on to equities, our buddy Lucio from Instagram, he had a question for us.
Yeah.
He's wondering what goes into our forecasted volatility.
Yeah, it's right here. Lucio. So we look at Garch. It's an ensemble of volatility. So we look at Garch.
What's Garch?
Garch is it's a way to explain volatility. It's probably one of the highest end models out there right now. It's just a model that tries to
pretty serious
forecast
model.
volatility. Okay, so we have Garch. We have Beta Eyeball. So this is going to be like depending on what the market is, because the market's very efficient. So given what the market is, what should the volatility of this asset be? Okay, so that's that. Then we have the implied volatility with the earnings stripped out. And then we have the intraday realized volatility. So we take the sum of these and then divide by 4. So we get the average of these 4, because each one of these brings a different thing to the table. And so that gives us our vol forecast, and it's a lot more accurate than the implied volatility. Okay.
What we basically are doing is we're taking out any of the market bias, and we're trying to understand what is fair price for volatility.
Yeah.
Right. Because, implied volatility is sensitive to, things like getting bid up. Right. News comes out, it gets bid up like crazy, but that isn't an accurate reflection of what's likely to actually happen in the future. It's not often a very accurate picture. Right. And you're going to see that as we look at earnings here. It becomes very, very apparent.
Okay, so let's take a look at a good one here. Okay, what do we got today? Today's what, the 13th, right? Yeah. Wow, man. There's some names tomorrow we got to trade here.
Yeah.
Okay. So let's take a look at what do you guys want to do here? Let's do I don't know if you want to do bank, you want to do Johnson & Johnson. We're probably going to trade them all.
Yeah, let's look at like 3 or 4. And guys, if you have any asset in particular that you want us to look at today, shoot a message into the chat box and we'll take a look at it for you.
Okay, let's do.
Yeah, we have one to do at the end. We have to look at MFA for our buddy Cab.
Okay, we'll do that one after. Do we have it here? What is it? A penny stock? I've never heard of it. MF. Oh, we do have it. Okay,
so
we'll
just quickly, Siddharth had a question. I'm just going to answer it quickly. So Siddharth, there are 2 ways that we find opportunity, right? So in the end of the day, there's 4,000 different optionable stocks, right? There's 2,000 equities, 4,000 optionable stocks. Where do you start? How do you know what to look at? So there's 2 ways that we do it. One, within our tool, we have a scanner. So we can, based on a number of different variables, whether we want to look at things that have high implied volatility, things that are highly liquid, things that have high implied versus realized, or high realized versus implied. There's a million different ways that we can sort all 1,400 equities that we look at. We look at the 1,400 most liquid equities. So we can sort them to find opportunities, which is what we're doing in the earnings scanner here. We're sorting them based on earnings date, so we can look at what companies have earnings today. So that's one example of how we scan for opportunities. The other way that we look at it is something that we found is that when there's a high volume of retail traders looking at stocks, they'll trend on StockTwits. And when they trend on StockTwits, there's usually good opportunity there, because a lot of the times the retail traders either aren't looking at how to trade options properly, or they are lagging behind the information. Basically, to sum it up, they're who we want on the other side of our trade. And if we can, the best way to make sure that they're on the other side of the trade is to make sure that they're looking at it. So that's why we would use StockTwits. We either use StockTwits or our scanner, one of the 2.
Okay, let's look at WFC just because it's so juicy.
All right, let's do it.
Okay, let me just make sure. Yeah, I'm just looking at this number. I'm looking at this column here, and this is just out of this world juicy. So we could talk about why this is so juicy. So if we look here, the implied move is 7.5, right? So that means the market thinks that Wells Fargo on their earnings is going to move up or down 7.5% tomorrow. Now, if we look historically, right? If we look at the historical moves over the earnings periods, it only moves 1.28% on average. We can also see that selling volatility or buying volatility has not done very well. So why is this thing so big? Why is there so much? Why is options so expensive right now? And the reason is
that's like a 5 times move.
Yeah, this is crazy,
5
right?
times the average
I don't think
move.
I've ever seen this in my life.
And it's never moved that much, ever.
Not even close. Oh, it moved negative 6.3% once. Okay, so why is this so big, right? And the answer is because, well, we're going through a volatile period, and hedge funds and mutual funds that own this thing, a lot of big pension firms own this thing, and they don't want that exposure. They don't want to hold WFC over earnings. They don't know what to expect. It's crazy right now. So what they do is they say, okay, I'm going to buy up insurance. I'm going to buy up the options. Hedge my position, and now I'm good to go. And so I'm willing to pay, and what they're saying right now is that I'm willing to pay any price for this. I'm willing to literally pay anything for insurance right now. Give me insurance. And so as a trader, we're going to say, sure, you want that insurance? No problem. We are going to provide that for you. We're going to sell you some options, and we're going to capture a spread, and we're going to do it on multiple equities, right? We're going to start treating this like an insurance business.
Right? Like the way you can think about this, if you wanted to draw a comparison to insurance, is that, you know, the likelihood of a crash is very low for this stock, but they're willing to pay the same premium as someone who's crashed 5 Ferraris. So we're going to sell them that insurance at the really high premium, knowing that it's unlikely that they're going to crash. You know, it doesn't mean that they're not going to crash. They could. We could have to pay out, but it's a very good risk reward bet. Right? The odds are in our favor of success. We're going to collect a huge premium, and they have to get into a pretty damn serious accident for us to be at a loss.
Yeah.
Very cool,
Exactly.
man. So let's look at one more thing here. So now that we found this inefficiency.
Yep.
Right. And we have, we've been in this game for a while, so we know that this is just something absurd. So, but let's say you wanted to go a level deeper, right? Something that we recommend to all the traders we work with, and something we do typically do ourselves all the time, is we'll try to look at why implied volatility is high. So before we put any sort of recommendation to anyone to take this trade, Jordan, you want to take a second and look at maybe what the analyst opinions are, or something, to help us maybe understand, like, can we do some research to understand why this volatility is so high?
Exactly. So what I would usually do. So first off, obviously, when it comes to earnings, it's usually because the analysts are a little scared. The analysts are a little worried, or the analysts don't know, and the investors are worried. But it's always good to check the news, right? It's always good to check the news. Is there anything going on today? Is there anything happening, right? Is there anything out of the ordinary? Is there anything that we should know about? Going that one step further. So I subscribe to a few data providers, to a few news providers, with Zacks through Interactive Brokers. And what I would do is I would just go in, just have a quick view, make sure that there's nothing crazy going on here. And it looks like, there's no breaking news here. All right. There's nothing that's popping out here.
Hey, Jordan.
They even say, yeah.
Just quickly, Patrick's asking, do we always choose the near dated options for expiration?
Yes.
Yeah, because we want to isolate that volatility, right?
Yeah. So it's not always. It's yeah. He said always, right?
Yeah. So like it's not 100%, but it's like 90%.
Yeah. There's reasons to choose near dated, and there's a reason to choose farther dated options. That's something we probably, it's too in depth to talk over over the YouTube thing.
Yeah. So that's actually that's Firefighter. So Patrick, just shoot Jordan a DM, or actually post it in the Bronze Trader group.
Yeah, post in the Bronze Trader group. But most of the time, Fire, we are going to be taking short dated options.
Yeah, like the way that I would think about it, right? At least at this level, like as you look at options today, is remember the 3 circles of volatility model we used to explain the different forms of volatility that impact an option. We're trying to isolate, when we're trading an earnings event, we want to minimize our exposure to market and non-event volatility, and increase and maximize our exposure to the event volatility, right? So by having, on average, by having the short dated options, we are able to reduce the amount of other forms of volatility impacting that trade.
Yep.
So basically for, what stock was that? WFC?
WFC, yeah, we're going to be shorting vol here.
Yeah, we're actually going to take this trade.
Yeah, we're going to be shorting this for sure. And like, you look, like on average, it does well shorting vol, right? Because buying vol does terrible, so shorting vol does good.
Exactly, right? This is the thing, right? When you're trading on the buy or sell side, right? You have to remember somebody's on the other side, and trading's a zero-sum game, right? This is a super competitive game that we're in here. Like, people think the business world is tough. This is like as cutthroat as it gets if you actually look at it seriously. And so for every dollar that we make or we lose, somebody on the other side is making or losing that dollar.
Always.
Every single time.
every single damn time.
So let's look at one or two more opportunities here. And actually, before we move on, maybe take a look at MFA. Cab was asking about that. He was actually the first comment. He asked about it right away. So let's take a look at that for him.
Okay. Sorry, one of our group members here is looking to do Lake earnings, but they don't have it. Is it? It's not till tomorrow. Okay, let me just mess it. Okay, so let's do MFA.
Yeah.
Okay, so what's going on here? What kind of stock is this? MFA. Let's pull this up here. Let's see what we got. Okay. So it looks like it's a financial company. They got earnings not confirmed.
Yeah. You want to take a look at the vol trader. This may not be an earnings trade.
Okay, so yeah, so first off, like you got to think, okay, what is my view here, right? Why do I want to take this trade? So it looks like, there's not too much action going on. It's okay, a little bit of action. It's got a lot of skew. Okay.
It has a little bit of a call side skew.
It has a little bit of call side skew. Yeah, let's take a look here. It's got some curvature. Or no, wait, does it? Let's see. It does. It does. So yeah, okay. So market's thinking there's going to be a big move here. Market's saying, okay, there's going to be a big move on this stock. There's actually quite a bit of call buying here. Quite a bit of call buying here, and we can even see from this little kink in the call side. So the market think it's going to be a big move, and they're leaning towards a positive move. Okay, I'm not too sure why. I'm not too sure what this stock's all about. I'd have to
do a quick Google search.
Yeah. Okay. Let's do it. MFA.
Yeah, just do a quick one.
Yeah. MFA.
Yeah. That was on the weekend.
It looks like they're doing some new news here coming out. Let's take a look.
Forbearance agreement. Interesting.
Yeah, so it looks like. Okay, I'll let you guys read the rest of this, but this looks like this might be driving it. Right? It looks like it's liquidating a lot of positions here. Right? It's getting rid of its swaps. Right? It looks like it's really it's getting liquid. It's getting liquid.
So that's actually really interesting.
Yeah, so that is probably driving why people are jumping on the call side here. I think things dropping down, it's getting a little more liquid. That's gonna boost the
at least in the short term.
At least in the short term, yeah. At least in the short term.
Because there are long-term risks that come with that, right?
Oh yeah, definitely. It slows growth.
Definitely. Right? And if they're liquidating their positions, like one thing you might want to look at is what's their debt.
Yeah.
How much debt does this company have? Because right, when you get into these tricky times where markets are very uncertain, right? Having cash on hand is good if you have a lot of debt, right? Lets you pay off that debt if things get worse. If interest rates start to go up, right? If these things happen, you can start paying off that debt. So you want to look at that, right? If you're looking to do a short-term play, it looks like it's going to move up. Yeah. You just want to make sure that if you're trading the option, there's a lot more to consider than just the direction. You want to make sure that you think it's going to move more than what the market thinks. Otherwise, there's no trade because the market thinks it's going to go up.
And you can also see here that the implied volatility is less than the realized volatility. And the intuition we can think of this is the company's going more into cash right now. So what is the volatility of cash? It's zero, right? Cash is a zero volatility. So as this company moves more into cash, the market's saying, okay, this should be, implied volatility should be dropping, right? It should be dropping because it's becoming less liquid. And so that's why we're seeing the implied volatility, come down quite a bit. Of course, you can our forecast is saying it's 311. So that's where, that's where you got to start digging deeper, right? How much is it? How much is this movement to cash going to affect the volatility of this company, right? And what we're saying is that the company's still going to move more than expected. Cool.
Very cool. Okay, so let's look at one more opportunity here.
Man, I got
Unless
a
we have
long
something
straddle in
that someone
RBC
wants to look at.
crushing me. What's that?
You got what, dude?
I got a long straddle in RBC. This just vol's been mute, and it's hurting me a little bit.
Oh,
Anyways,
man.
what's going on?
Let's look at one more opportunity. We don't have any more questions as of right now.
Okay.
Obviously, if you guys have the questions, let's we'll go over everything that you want to know. But if not, we're going to look at one more opportunity here. Jordan, whatever one you want to pick, right? And these are trades that you can actually take, right?
Any one you're saying?
Yeah, look at whichever one you want.
Okay, just because Ashton in our group is on JP Morgan here, we're gonna pop in on JPM.
Cool. Let's have a look.
They got earnings tonight as well, tomorrow morning. Implied move way higher than realized. Obviously, this is a great short. We're gonna be short this thing like no tomorrow.
Wait. Oh, okay. Yeah.
We're gonna be short this thing like no tomorrow. Here, let me get rid of this. I mean,
when's this? Is this tomorrow? No.
Tomorrow morning, yeah, tomorrow morning. So
Nice.
we're gonna be short all the banks tomorrow, I think. Yep, it's gonna be fun. It's gonna be exciting. We're looking forward to good earnings. I mean, there's not much more to talk about here. Implied move is high. It's never moved more than 6% ever. Right, the highest move was 4.7. There's no seasonal thing. There's no seasonal problems here, right? This is we're Q2. Sure, we got a little bit of a bigger move here, but actually, no, we are releasing Q1.
Yeah, exactly.
We're releasing Q1, so this vol should be mute, right? If we look at the last 4 times, it had Q1 barely moved. So we like selling vol on Q1 here. Yeah, it should be reasonable. Should be a pretty good trade.
Yeah, no, that's exciting.
Yeah.
I'm honestly, for anyone who's serious about options, this is going to be a phenomenal earnings season, right? The way to think about it is like this: volatility drives inefficiency, and volatility drives inefficiency, and inefficiency drives opportunity, right? If the market was perfectly efficient, there would be no trades. And the more inefficient it is, the more there is to capture. That's why I'm so excited for this earnings season.
Exactly.
So Taylor Patton saying here, if you vote for the JPM option, right? So I guess if that's a trade we want to take, when would you do it, right? The person has not traded an option yet.
So I would, well, it depends what I want to trade. So if I want to trade, let's say the event, okay. Let's say I want to trade the Fed meeting, okay. I want to trade the Fed announcement, and so I'm going to short macro vol. Let's say. When would I want to trade that, right? And I'd want to trade that around the event because that is my view. My view is the event. So I don't want to be trading stuff that's not the event because that's not my view. So I want to get as close as I can to the event, buy or sell. And then once the event's over, I want to be closing my position, right? A lot of the times people take positions and they end up getting caught up in a whole bunch of other news and a whole bunch of other events happening. But the reality is, as a trader, if you have a view on something, you want to get rid of all the other risks and just trade that one event. So in this case, it'd be just before the earnings announcement. So 355 for me.
So, and what I'll say is this, Taylor, what you want to be doing here, right? A trap that a lot of the retail traders, especially when they're getting in, will fall into is what we're saying here is that options are expensive. We're not saying that you should buy a put. We're not saying that you should bet on it going down. We're not saying that it's going to go up. What we're saying is that the amount that the market thinks this thing is going to move is a lot higher than what we think it's actually going to move. So as something you can look up is the correlation between implied volatility and the price of options, right? You got to do some research there. These are things that you really got to understand before you actually start placing trades. But if you wanted to take a view on JP Morgan being more expensive than it should be, what you would want to do is sell either an iron butterfly or an iron condor.
Yeah.
So you have defined risk still, and you can take a sell view. You can be what we call short volatility. So you're not shorting the stock, you're shorting the volatility itself. You're basically saying that people are willing to overpay for these options. So I'm going to sell them the options, collect the premium, and then the amount that I have to pay out from the stock moving is going to be pennies, and I get to keep the dollar.
Yep.
Or that the amount it's going to move is going to be less than what I collected in premium, and I'm going to come out of this with a profit. That's the view that we're taking on this stock. And right, we reached it through a logical sort of analysis.
Nice.
So let's see, Jordan, if there's anything else you want to look at, or okay, we got one more question here, and then if there's no more questions by the time we're done answering this one, we're gonna wrap it up here. We are gonna be doing this every day. So subscribe every single day, 10:30 a.m. Monday to Friday. We'll be doing these. Feel free to tune in. Any stock you're looking at, we'll look at. If you're looking for opportunities or looking to learn, we can go through it. Yeah, Taylor, it is tricky stuff. This is stuff that it takes time. We've been trading for cumulatively 10 years between us. So, we have a lot of practice, and thankfully it has paid off. One of the reasons we do these though is because we got pretty lucky. Like we had really good mentors, right? We had portfolio managers that helped us out, hedge fund managers that, as we got better, they gave us their time. They invested into our success. So we're basically here trying to show people the actual things they need to be looking at to win in this game long term. Because what I see is that, a lot of people come into this game thinking that it's pretty straightforward, but what they don't realize is that, so they jump from learning about put calls to learning about psychology and getting in and out of trades. But they skip over really taking a look at, is the strategy they're using still applicable? And if they stopped and looked for a minute, what they would see is that the landscape has changed. People are using old maps, trying to get financially free using options and stocks. And it's a losing game for a lot of people because they're just using outdated information, outdated strategies, and an outdated map trying to find this treasure chest. So we're just basically trying to show people here, this is sort of what the updated map looks like. You want to navigate this landscape, you need to have this sort of information. You need to know how to work with this sort of information. So question here from Lucio.
Yep.
Lucio saying, looking at JP Morgan, he said, so you could sell a call and a put, shorting Vega, natural data, and long theta, natural delta and long theta.
Neutral delta.
Oh, neutral, sorry.
Yeah, that's exactly it. Short Vega, neutral delta, so you have no directional risk. Short Vega, and your long theta, right? Your short gamma.
So, but Lucio, something we add on there, especially during these uncertain times, you want to make sure that your risk is defined, right? You don't want to be going into this with a naked position.
Exactly.
So you actually want to probably buy the wings, right? Remember, at the end of the day, all this does is give us an edge. This thing could crash. It's totally possible that it could crash, and that's why we look at more than one opportunity. That's why the scanner is so valuable, because if we were only trading one opportunity, who knows? But when we spread it across a bunch, we end up coming out really profitable. Like, for example, last year, we placed over 2,000 trades, right? We placed a ton of trades, but we basically ended up doubling our portfolio. Our entire portfolio basically doubled. So, right, think of it like an insurance company. If an insurance company only ever insured one driver, once that person crashes, they're going to be paying out a lot. So they spread it. They insure 1 million drivers. They assess them all. They determine what premium to be charging. And once they have all of that done, they sell mass amounts of insurance. Then when one person crashes, it's not a huge deal. And what you can actually look at if you want to research what this mentality is, it's expected value. So Lucy, I'm sure you know, but I'm sharing it for everyone else who's watching. You have to think in terms of expected value. So anytime you have a positive expected value for your trade that meets your individual risk and reward requirements, you want to be taking that position. And then you want to be able to find every time that opportunity comes up, every time you have that positive expected value that meets your requirements. And then you want to hit it every time.
Exactly. And something, you know, I want to mention, I was talking to one of our guys about this, you know, where it was like, it's a little challenging. It's a little tricky, right? And the thing is, like, people go to school for this stuff. You know, they spend years and years learning this stuff. It's not, it's a profession. You know, trading is a profession. And I think a lot of people forget that. They think they can just treat it as a hobby. You know, it's a serious game. You know, you gotta respect the game, and it's very serious. So, you know, it might take a little while to learn this, but once you understand it, it's well worth the effort.
Yeah, right. Like, this is not a game you come into because it's easy, right? Like, what's more challenging than competition, right? Because now it's not like you're playing against some arbitrary thing, right? It's not like you have a set of tasks to complete and then you get paid, right? You have to be better than the person on the other side, right? You look at anyone who competes in a competitive landscape, you look at professional athletes, you look at businesses, right? Startups, you look at even salespeople, you look at sales. Sales is super competitive. And the people who are at the top, they do above and beyond what everyone else does. And the thing about trading right now that's driving me crazy is there is huge opportunity for people who can put in the effort into the right spaces, because there's a gap right now. There's a gap between what pros are doing and what everyone else is doing. This type of information is that gap. So every single day we're going to be talking about this stuff. And if you can wrap your head around it, I promise you now that you are setting yourself up for success in this game.
Yeah, definitely.
Right? It took us 5 years to learn this stuff. 5 years, mentorship from people who literally manage hundreds of millions of dollars, learning a ton of skills, and all this work because there was no one to guide us long term. Like, there was no one actually giving out this type of information. That's why we're doing this, right? So when you see me do, you know, some of the guys here are from that group, the options trading one that I joined on Discord, right? When you see me doing analysis in that group, it's me just basically trying to say, guys, this is how we need to be thinking about things, right? You know, a lot of people in the group disagree with me, but remember this. You know you're doing something right when 95% of people think you're crazy, and 5% of actually smart people have their eyes on you and know what you're up to. You want to be in that type of a position, and that's when you know you're on the right track. When you sit down at your dinner table with your family who maybe is interested in options and nobody knows what you're talking about, but then your uncle that you know, works at a hedge fund or manages a bank or something nods and goes, okay, I see. How long have you been trading again? You know, that's the position you want to be in. You want to be that person at the table.
Okay. If we don't have any more questions, we'll move on, because you know, I'd rather keep these lives short, 45 minutes. I think it's a good time for these lives.
Yeah.
So yeah, if you guys want to chat
we're all
about
good on the
else
questions.
before we rock and roll, we'll end it there.
Okay, we'll be doing these every day, right? And you know, unless you guys want them, I won't rant so much about what we need to be looking at. But oh, we got one more here. Someone saying, what about Newmont? You want to take a quick look at it?
Yeah, actually, I just posted a thing on StockTwits about this.
Oh, yeah?
Yeah. So here was the trade. The trade was this. Put side vol. Let me just make sure the trade is still there. Okay, yeah, perfect. So if we look at gold, okay, so Newmont's a gold mining company. If we look at gold, you can see the calls are really expensive. Okay, really expensive. But for Newmont, the puts are really expensive. So this is a trade that can be done here. And the trades, it's called the relative value trade. So what you can do is you can sell gold calls and buy Newmont calls. because the calls for the Newmont's gonna be cheaper than for gold, right? In volatility terms, so you can sell these and buy Newmont, capture a really good spread there. So that's a trade idea that I recommended. I think it was on Thursday last week, and so far it's looking good. So you might want
Really
to take a look
cool.
into that. Yeah, but other than that, volatility. Let's take a look at volatility real quick, and then we'll head out of here. Let's take a look. Implied is pretty much in line with realized. I wouldn't be getting too excited about this. It does have a lot of skew. Given that gold usually has volatility to the upside, you could be selling the puts here if you want. Sell some out of the money puts. Those are pretty juicy, and they'll probably give you a nice return as volatility is usually to the upside. Cool.
All right, everyone. I think we're going to wrap it up there.
Yeah, let's do it.
If you like this, though, by the way, Cab, I know you're in that group with me. If you don't mind leaving a little comment about what you thought, that'd be great, because I'm trying my best. I want to bring this to everyone, right? We're going to do this every day for free live. I think it's so important that people start to see what modern trading looks like. This is modern trading. This is what the pros are doing. This is what people making consistent money and building lives out of trading are doing today. So I'd really appreciate that. But if we don't got anything else, we're going to wrap it up there. Amazing, everyone. We'll talk soon.
Okay. Yo, dude.